Faina, can you explain just at a high level what happened at Silicon Valley Bank?
Right. So Silicon Valley Bank was a California-based bank, the 16th largest bank in the US, founded in the 80s. And this bank was unique in that it banked half of venture capital backed startups in the US and also about half of venture backed tech and biotech companies that went public last year and the year before. And the way that banks make money is that they, pay depositors a small rate for the depositors to keep their money with the bank, and then they invest in securities or they make loans and make interest on those. And the difference between the interest that banks make on loans and securities and the interest that they pay depositors is what's called the net interest margin. So that's how banks make money. So Silicon Valley Bank got a huge inflow of deposits in 2020, 21, and they had to put that money somewhere. And they decided to put a lot of that into long duration securities. Now, what happened was we saw near record inflation, decades high inflation, and the Fed started to raise rates at the fastest pace in US history. At the same time that rates were rising, depositors at Silicon Valley Bank, these venture-backed firms, were burning through cash and it was harder to raise more money. So deposits were flowing out of Silicon Valley Bank as opposed to in during COVID. And Silicon Valley to shore up liquidity, to be able to, cover those deposit outflows, and also to be able to make higher interest on their securities book, decided to sell part of their securities book, these long duration securities, and at the same time to increase borrowing capacity to be able to borrow more. And they wanted to raise equity at the same time. That spooked investors and it spooked depositors. And at the same time, as you might know, the venture capital community and all those companies that are backed by venture capital firms are in constant communication. They're active on social media. They're active in their channels, and fear spread very quickly. And depositors pulled out their money at an even faster rate. And that was what became a run on the bank at Silicon Valley Bank. And Silicon Valley Bank could not meet those deposits, and it had to be taken into what's called receivership by the FDIC. And so that's what happened to Silicon Valley Bank. And unfortunately, this has spread fear and concerns across the banking industry.
Was there something unique about Silicon Valley Bank that made it uniquely risky for something like this to happen?
So there are some things that are unique about Silicon Valley Bank. It had a fairly concentrated depositor base. It also, by the end of last year, had more than half of its assets in securities compared to the regional bank average of 20%. While Silicon Valley Bank had unique risks, rates have gone up across the board, and banks across the US, both regional banks and big banks, are sitting on losses on their securities books. Silicon Valley just had a really big concentration of securities in their assets.
So this is the biggest bank failure since Washington Mutual back in 2008, which coincided with the financial crisis. So does this type of event have the ability to lead to broader consequences?
I think it could. I believe that the Fed values financial stability and stability in the banking system. That's why it came out with a new liquidity program on Sunday. The Fed is focused on preventing contagion to the extent that it can with the tools that it has. But there could be big implications. We're seeing Credit Suisse today in turmoil. It is the second largest bank in Switzerland, and it is a SIFI, or a systematically important financial institution. So if it fails, if it gets into more trouble, there could be very broad implications. And specifically on Silicon Valley Bank, it was the bank to the innovation economy in the US. it will almost certainly be harder for startups, venture-backed companies to be able to raise money. And I think this could stifle the innovation economy, at least for some time in the US. So there are broad-ranging implications through the banking industry and beyond.
Faina, can you just give us some big takeaways that you have from this event that people could be thinking about?
Sure, Sean. So there are three big takeaways for me. And the first one is that extreme actions often lead to extreme reactions. The banking sector helped manage trillions of dollars of stimulus during COVID. Deposits at banks surged, and they had to put that money into interest earning assets at a time when interest rates were very low. We saw decades high inflation and then the Fed raising interest rates at a record pace. It almost seems inevitable that something would break. And this is the second learning, is that bank regulation is probably going to get more strict. Regulators were really focused on the big banks, the systematically important banks after the great financial crisis, and the regional or middle market banks had less regulation. Now that is probably going to change. And then we just have to understand that the banking industry is very challenging. It's cyclical, it's heavily regulated, it's competitive. If there's a recession, then credit quality is going to impact bank profitability. There are all of these tail risks. So Silicon Valley Bank was unique because its depositor base was concentrated and it was sitting on more assets in securities than other banks. But all banks have securities on their balance sheet that are underwater.